All right, quick look through. We look like the rates are gonna come down significantly. All right, well, it's like all right, so I figured at the beginning of this video, I might actually go through pretty much everything and see what that initial reaction is from the Federal Reserve's economic projections and what we got. We got the pause or whatever, so it is staying at that 5.5. Looks like TLT's rocketing, which tells you 10-year yields going freaking down. And then we will be watching that right over here, by the way. I already have it up. The dollar dropping off really heavy, so people are really going to buy into this move. VIX popped a little bit, dropping down, tested that 12.12. HYG making that big high. Okay, SPY coming up to its weekly expected move as of right now. SPY coming up to that weekly expected move. Q's already hit the weekly expected move, so I'm going to pay attention to mainly the Q's while we listen to them. Apple did come up a little bit higher. What I might point out later on is that 30-minute. You could have been creating another divergence here, but you ended up not. So you can see this 2-hour divergence. Which 2-hour divergences are really strong, especially this like clear. I would just consider this triple at this point. Amazon not really popping. So this is really good news. People are going to wait for what he actually has to say. Now, Tesla has been dropping, and it actually came into its weekly expected move down in here. So NVIDIA's popping a little bit. So we're not going to get that thumbs up for the head and shoulders. But what are you guys noticing out there? Is there anything that you guys are paying attention to as of right now? Really want to know what you guys are paying attention to while he talks. I'm just going to pull up the cues. I think I'm just going to be chill, have this up. You are. And hopefully the volume's good. You guys will have to tell me about that. How's everyone's day going? I got my afternoon coffee. So mine's going pretty good. Now, if you do want to talk about it real quick before we actually get into his speech, which if you didn't read what was posted, he overall usually just reads it word for word at the very beginning. So stick around if you didn't read that. Oh shoot, what was that I was gonna do? I literally just forgot. Oh, that's right. There's kind of two cases from here that I kind of see happening at least. And that is either we're going to sell off today, and it's a sell one and a melt up one, really. It's either we're going to sell off throughout the rest of the week and going into next week, or we're actually going to melt up. So even if we melt up for a couple days here and then we see the sell off next week, or we could just keep melting up if people really see this as good news. And the reason I'm saying that is just because if, NVIDIA kind of led the market on everything, and you can see, and this is what was pointed out in the video, you can see the buy signal showing up, closing above all these moving averages here. And at the same time, if this is able to cross, probabilities for some upside start to go up a little bit. But I'd like to hear your guys' thoughts. I just wanted to show you guys how the SPY is currently coming up into its weekly expected move, and the Q's actually surpassed it. So it opens the door for that upward expected move here of 403.21 for the day. So the pink ones are the daily, the purple is the weekly. And these do get touched a lot, and I don't think they were touched in the last like 2 weeks or something like that. So we kind of were due for these weekly ranges to get gravitated towards. But we can see even on a 15-minute, we're setting up some kind of divergence here. If we do want to sell off, we could go into that negative territory, start that negative trend. I want to hear your guys' thoughts if you have any. we'll just watch Mr. Jerome. Well, I don't even know if Jerome's the one talking. He usually always is, so. He's the speaker. Oh, God. Afternoon coffee. So good. Got my lucky Squirtle hat on, just to bring me a little more luck today, you know? Wish I could play music on stream. YouTube is like very, very diligent about spotting people who play music on their stream. I've streamed a lot. I was trying to see if anything's telling us something different, but the fact that these, rates are TLT's going up, now you get that flatness up here. We were talking about how it's down, SPY's creeping up to higher levels. So if TLT sells off from here, you still have that divergence between smart money and dumb money. But if it doesn't and it wants to catch up to the SPY, kind of like the Qs did here, right? We caught up to the SPY, then we could run into a lot of issues. Because that could mean that we're actually going to see a full-fledged crash like early 2024. This is just the final melt up. That's why I really want to see some kind of pullback, because it would be a little bit better for the market, I think. Sorry, I'm a bit sniffly today. If you see me wipe my nose a bunch, I apologize. And if you see me look to my left, I have the stream up over here. I don't have my full setup just yet. I get it on, actually I get it this weekend. I can have the full setup this weekend. But for now, I have to look at my iPad to see what you guys say. And nobody's even said hi. You guys are probably busy at work. Oh, wrong one. And PPI came in, previous got down to negative 0.4. It's supposed to come in higher, but it came in at 0, which is higher than the previous, but it's coming below the projection. So maybe that's why we're a little bit bullish today overall. And then down here, we can see that flatness there. Projections, the Federal Reserve kept the Fed funds rate steady at 5.25 to 5.5 for a third consecutive meeting in December 2023, in line with expectations, but indicated 75 basis points cuts in 2024. And this is what we were kind of talking about on the channel was, hey, Peter, what's going on? What we were talking about was the fact that the way this market has gone up, it looks like it's priced in maybe double that, like 150 basis points at this point. So really have to look at it. It's like 125, 150. Policymakers said that recent indicators suggest that economic growth has slowed and job gains have moderated but remain strong, and the unemployment rate has remained low. I mean, they always said they needed unemployment to go higher, but all they do is talk about how it's low. We'll have to see about that. Maybe an unemployment question would be good, especially going into 2024. Inflation has eased over the past year, but remains elevated. The classic line, it remains elevated, Peter. It remains up there. Central Bank also published new projections. GDP growth is expected higher this year, 2.6% versus 2.1% in the September projection, but slightly lower in 2024. So they're expecting that to come down in 2024, 1.4 versus 1.5, so not that much. Also, PCE inflation was revised lower for both 2023, 2.8 versus 3.3. That's a pretty big difference. And 2024, 2.4, 2.5. As well as core PCE inflation, which is, so pretty much he's going to talk, like he's going to have a statement at the beginning and he'll go over most of this. But we can see how the market really likes it at this point. Of course they are. It's cuts. That's what people were talking about. Now we have to see if he's going to maybe come with that higher for longer narrative and really hit home. or if we're going to see further melt up. And the good part here is, we're in positive territory on almost every chart. So we do see that curl up, most likely on like NVIDIA or something like that. We might see that extension. This is an informative channel. Recently subscribed. Great job. Hey, thank you. I really appreciate that. I try my best. I feel like I need to get a little bit better at just pointing out what is the main important thing when I go over the charts in my videos, like I did in yesterday's when I was just like, hey, let's, we can look at the shorter time frames. You're going to see divergence everywhere because we're trickling up. We always say, wait till it gets into that negative territory on the MACD. But in that case, I need to show you really what I'm paying attention to is that divergence on like the SPY or something like that. So the daily here, we can see we're going up and up. And there's just a little divergence starting to peak. Now that's not there on the RSI anymore. So maybe we go over to the Qs. It's not there on the Qs anymore. So you could say, at least from my style and my history of trading, when they're not at the same time, you can get a pullback. It just may not be a full-fledged reversal. So if they were at the same time, like we were at the top of the market a few years ago, you'll see an actual reversal and we'll go into bear market. But since you're not getting them at the same time, I would say this is more leaning towards a pullback. Please like the live video. I feel like I try not to ask for likes or anything like that, but it actually really does help out the channel. All right, we got 7 minutes. Get your coffee ready, 7 minutes. My Photoshop's still up. Yeah, your boy makes his own thumbnail. It's whatever. Anybody have any good trades today? As we got 6 minutes left, someone better have a win out there. Outside of the expected move, we land within this 68% of the time. Go over this in my course. It's just it's pretty much a bell curve though, so it's kind of like this. This is that 68. That's that one standard deviation. So you can see how we gravitate towards it and we reject like right off of that weekly expected move. We consolidate and then we get the news. We head higher. Video calls, hope it goes to the moon. Yeah, and this is what we just said a second ago, but we can go over it again. Shorter time frames. We're just watching for the actual speech. I don't normally do 15-minute, but if you get this to cross, right? If you get this MACD here to cross, you have a very, very good probability that this is going to extend past this high. I don't know exactly where. I have kind of linked a spot between these two highs here. Maybe we actually do go all the way up towards like a 560 or something like that. That would be kind of insane, but it's totally understandable. It's kind of like you could be leaning both ways at this point. Like there's a case for both sides. Tesla's telling us a little something different though. It's down 1.5%. It's down towards the bottom of its weekly expected move at this point. Also, NVIDIA's already at the moon, man. Shoot, how high has NVIDIA gone? It's like, let's just do like a weekly. My goodness. Like if that's not mooning, if that's not the moon, then I don't know what is. And this is what we're gonna do on Saturday morning. I'm gonna do kind of a bigger picture. I'm gonna do a kind of a bigger picture because like this even right here, if we flip around for more than 2 weeks, my headphones turned off. If we flip around for more than 2 weeks, like if we do get the pullback, we go to lower levels, and we do that for more than 2 weeks, you're gonna get this MACD to cross. And that could be very, very bad. Because you notice there's divergence on the weekly, and that's what we're going to talk about on Saturday. You got the divergence here, same here. So you do have the potential that we could break down pretty much any time over the next few weeks. That's why you want it to be kind of a sharp, quick pullback and then start to head to higher levels. But let's just watch a 15-minute. He's about to start in 4 minutes. But good luck on your NVIDIA play. It's definitely pumped. Me and my brother, the biggest pump that I ever got was when I was messing around and me and my brother bought like $300 worth of Dogecoin. And I think it became worth $300. I think it became worth $25,000. It's Dogecoin. You got to buy some Dogecoin. But not anymore. But we bought it way back before it pumped. And yeah. And I sold mine because I'm a sell kind of guy. If I think I only made like $7,000 because I sold mine. But my brother, my brother's was worth $30,000 alone. So just his portion was worth $30,000 because he never sold it. And then he said it's going to the moon, didn't sell it, and then he sold it for around what I sold it for, about $7,000, $6,000. Yeah, it teaches you a lesson. It's like, how much is enough? If $10,000 can really help you out right now, and you get lucky like that, take the $10,000, take the $30,000 especially. Like, Jesus, how much more do you want to make off $300? Pretty big stuff, Omar. I was like, $6,000-7,000, good enough for me. There's some book that I read that said like something to do with stocks. There was some book that I read that was like, it's the people who, it pretty much says like, it's the people who learn just how to take profit when they've made money that end up winning a lot of the time in the market. Like people who are like, ooh, I turned $40 into $100. I should sell that. Yeah, you just doubled it. You double and a halved it. But as of right now, on the 15-minute, if the technicals are going to tell us something, as far as the 15-minute, which I don't follow the 15-minute too often, I'm a 30-minute, hourly, 2-hour, and daily for my trades. But the 15-minute here right before the talk, showing a divergence. I would really expect this with that, because he reads that statement. He's going to say again that where they're holding the rates at and that they're cutting at some point, right? So we probably will head up towards this daily expected move. At some point, we most likely will. I'm going to wait till someone walks out to the podium. But I'll try to keep it pretty quiet. I'll just mute my mic. Let's just really listen to them, and I'll try to... I don't tune in too much. I just kind of tune in or take a quick note. Let me get my notepad out. This signal called... Sometimes I write my titles there. All right, we're just going to leave that there. See if there's anything we need to write. It's good to take some notes, like what you see as important, or at least take like, I usually only take like 2 notes. I'm like, okay, he said he's going, to hold it higher for longer. I write that down. If he changes his language and he says he's going to, start cutting more aggressively and he thinks we can keep cutting, I'm going to write that down because that's different. All right, let's listen.
Good afternoon.
Oh, God, that's quiet.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
Let me know if the sound quality is good enough for
it's
Jerome
natural
Powell.
to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal.
Okay, he's returning inflation.
Restoring price stability is essential to achieve a sustained
quarter
period
one or
of strong
quarter
labor
three
market
in my
conditions that
book.
benefit all.
Oh, we're selling off.
Since early last year, the
Interesting.
FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment.
Just remember,
and
as
stable
we
prices
approach that
for the
daily
American people.
expected move, which is this
My
pink line up
colleagues and I
here,
are acutely
that's where
aware
the
that
sellers
high
could lurk,
inflation
and this
imposes
is all
significant hardship
pre-written
as
stuff.
it erodes purchasing
It's when the
power,
questions come in that
especially
we
for
can
those
see some
least
kind of turn.
able to meet the higher costs of essentials like food,
Pay attention to the
housing,
questions
and transportation.
more so than what he's saying.
We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
So now's the important part. We're up towards that daily expected move. Now we'll get the questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that
Vague on purpose.
you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Oh, touch the daily expected move. And also write down if you have any thoughts while they're talking.
Steve Leisman, CNBC.
Anything like that.
Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, People generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's, when you get to that question, and that's your answer, there's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this. We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not.
He's done.
That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was, and there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing, and a preliminary kind of a discussion like that. Not everybody did that, but many people did, and I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for. Thanks.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that.
Oh.
I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing.
Yes.
So it's always a real possibility.
Just said there's a probability
is,
of next year
is it
being recession.
So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters, a very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks, really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when
Depends what
potential
you mean by
growth
fuel.
this year might even have been higher than that, just because of the
Explain a
healing
little
on the
bit. What do you mean
supply
by
side.
fuel?
So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen, strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing
I got it
so
written
many
down.
of
We'll
the
go over
indicators
some
coming
stuff.
back to normal, not all of them. But so I
wanna make
think
sure
that
not to
people look at
miss
that
me.
and they write down they basically, each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case.
That's a pretty bullish
obviously, as it was,
to say.
60, 90 days ago. So that's how we're approaching
said we have no
things.
need to go higher.
As I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place, and that's a discussion we'll be having going forward. But that's another assessment that we're going to make very carefully. So, as time goes forward.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March.
This is where he's calling him out on saying he doesn't pay attention to the
comfortable
market
with?
or the economy. He does pay attention to the market.
So this last year has been remarkable for the
We
the sort of
price it in
seesaw
first.
thing back and
They
forth
correct
we've
it.
had over the course of the year of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals. And that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial
Think a
conditions
rate hike is
become
coming?
aligned or are aligned
It
with what we're
could.
trying to
We'll talk
accomplish.
about
And
that
in the long run, they
second.
will be, of course,
One of
because
these.
we will do what it takes to get to our goals. And ultimately, that will mean that financial
Once we're done, we'll
conditions
talk
will
about
will
these
come
little
along.
notes I have.
But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're
At
pleased
this point,
with the
they move
progress,
carefully for years.
but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary
That's
to cut
this
rates,
note.
or would
She's
continued
asking
progress
kind
on
of about
inflation
this right
alone be
here.
sufficient?
So we'll look at the
talk about it.
totality of the data. Growth is one thing. So is inflation. So is labor market data. So
Guys,
we
let's see
look
1
at the
minute for
total-
it.
If we make decisions about policy
hate
changes
1-minute
going
charts,
forward, we're looking
man.
at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But, if we see stronger growth, we will set policy according to what we actually see. And so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again.
GDPs, guys.
It just is. It's the way our policy works.
That's where we'll talk about the recession thing again. Strong
Hi, Chair Powell.
GDP.
Neil
She's
Irwin with,
asking about
Axios.
this. No
How
recession,
do you
then what
interpret the state of
happens?
the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So
I'm not gonna
on
tell
the
you.
better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor is being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
But early on, he was stating how he needs a weak job market in order to fight inflation fully. They don't have that.
I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, then when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming
Prices
down,
won't
but
go down.
overall,
that's what we're going to talk about.
The price level is not good. So people are still living with high prices.
This again is very important.
That is something that people don't like, and what will happen with that is wages are now real wages are now positive. So that
he's really stuttering on
more
this.
Than inflation as inflation comes down, and so that might help improve the mood of people. But we do see those public opinion surveys.
Shaky.
The thing that we can do
no such thing as a
is
soft landing.
to
I'm with you on
store
that
jobs, which is to use our tools to
right there with
foster
you on that one.
price stability,
We're going to explain it
which
after
has
he's
such
done.
great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria?
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
that's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously, what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe
he
a
is
situation
stuttering
like
a
that where
lot
if
today.
it were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
In 2 years, it could take longer than 2 years.
From Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve
Soft landing
and starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward.
Yeah, they have to. There's
and
pretty
the
much
things we'll be
two
looking
bad
at,
things.
I've already described. You know, we're
when it comes to
obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median participant wrote down 1.4% growth, but we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
You just threw that in at the
you
end.
begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
I mean, he's going to say they are.
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, really
We haven't even talked about.
We're sort of just at the beginning of
We're just
of that
telling you we're
discussion.
going to cut, but we haven't really talked about it.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business.
God. Yes, they have.
If the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year?
We're approaching the monthly expected move now on the Qs, by the way.
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something,
That's the way
this, but allow me to say it again. We don't
Weekly
debate
expected
or
move.
discuss what
Boom.
the right, whose SEP is right. We just say what they are and we tabulate.
You had to
them
play
also.
catch up.
So it's important for people to know that, but it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well,
yes,
that's what we're finding out, and we've seen real progress.
Does he know anything?
In core inflation? It has been sticky, and famously, the service sector
is
thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
My boy seems a little flustered today. Wonder why. Interesting.
Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Okay, and you see, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment. Someone once said that you know the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Let's go to Jennifer.
That's a very positive way to look at it.
Jennifer Schellenberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So when looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be
because there's a lag effect.
Reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
Do you think below 3% would be reasonable?
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Look for this to come back within this pink line by the end of the day.
Hi, Chair Powell, Jean Young
1
with
hour
Market
left.
News. Wanted to go
50
back
minutes
to
left
the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation, or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think this,
we
felt
coming in with that question
since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there was something different about the U.S. economy.
Yeah, so
is the U.S. different? Because every other one will crash if we do this.
The U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about.
Really?
It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And, we had the view, my colleagues and I broadly had the view, that we could get a lot of, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand lowered, reduced, and something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run. We definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it goes down to demand, and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down, the labor market keeps getting back into balance, and it's so far so good. Although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
It's gonna get harder, dude. I'm just telling you.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
Going back within the daily range with that last question.
We're not talking about altering the pace of QT right now. Just to get that out of the way.
Can be used as support,
so,
by the way.
Balance sheet seems to be working
so if we don't break below it.
pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or, as a result, or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out, and at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
You seem surprised, like it's
Adjusting
working.
that thinking at all by the time you're considering or
Very
moving
weird
forward with
vibe.
rate cuts? Is that time to rethink, or are you still going to follow
That's
that
a good
thinking?
follow-up. I don't know. I'm just the chair of the Fed.
I think they're on independent tracks. So you're asking, though, the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time.
Thank you.
Thanks very much.
All right, I think that's it. That's all we're going to get. Oh, we're coming back in the daily here, and this is why we're talking about how to pay attention, because while he talks a lot of the time, we do come up and then we start to come back down. We're going to go through some little notes that I wrote down, some things that you guys were writing during that chat, and a lot of them relate to each other, but I'll try to go through them pretty significantly here. And we're really starting to come down after that talk, okay? And that makes total sense, right? Because this is, as someone pointed out, this is something that was priced into the market. So if you come over to a daily or so, right, and then we go pull up yields, but right now we can just do this. It's pretty much this run right here, at least I would say this most recent run, is because of the pivoting, the cutting of rates narrative. So the fact that that's already priced in and he's actually not going to cut as much as what is priced in, that means that this price actually should come down. All right, so that's just overall the style of thinking. And someone pointed out, Fed Jerome Powell, they're giving the market what it wanted. What else? And that's a good question because it needs more to keep extending from here because it's already priced in that this is happening. So it's kind of a scenario of, do we just melt up completely, or is this divergence that we're seeing here on the MACD going to play out? You don't have it on the RSI, so that's why I wouldn't say this is going to be where everything tears down to nothing and we get a huge crash, but it makes sense to get a pullback when we didn't get more than what was expected, right? Okay, but let's go through some of these notes here. So the first thing someone did say in the chat was premature for them to cut rates. We're going to kind of relate almost everything back to this no recession. So one of the scenarios for a premature cutting of rates is, we're just going to do this real quick. All right. So we'll pay attention to price in the next 3 minutes. But right now you have to think, okay, premature cutting. So if they do see inflation rising like this all of a sudden, and then now it's just rising normal again, right? So that would be the 2%. It goes kind of like this, but we've experienced that. And now we're going back to this is what they're trying to get to. So the point of all this with that premature, right? The premature cutting of rates, if they do cut rates too early, this, if we get no recession, does not come down. The inflation itself, the price of your goods, won't come down at all. Recession is actually what causes demand to stop, people losing jobs. It causes GDP to go negative, which then can bring prices back down. But because these prices are so elevated, if we would happen to cut too soon and say we don't go into recession, what you're asking for, instead of a big vertical line like this one, not too vertical, but pretty steep, right? You're asking for later on, if the demand keeps going strong, you can see a even steeper surge in that inflation. So that's one of the things they have to be very, very careful about. All right, so that is one of the things. Now, if you were, let's say what's the other note? Let's just go through these. Okay, no recession now. What does that mean later? So in this scenario where you do get the inflation comes up, we see it spike, we even it out again with those rate raising, and then we see another big spike. So what happens from here is, now because you didn't have the recession here to bring price down, you're most likely going to have a worse or longer recession to bring price back down. So that's just overall the problem that they're trying to solve. They're trying to go right in between that. And they can't really make prices come down without literally getting a recession. That's kind of what a recession does. So does anyone, and please correct me if you think that I'm wrong or you have something to add to it, but that's just overall how I've thought about it, how I've studied it. I've really just looked at it and been like, okay, so if you want inflation to come back in, that would be the cutting too soon or cutting too fast. And if you don't want inflation to come in, you actually want a minor recession. And that's why a lot of people early on were just stating how with the rates, instead of raising them slowly over time like this, just spike that rate up, because it's kind of like if you're trying to lose weight, right? So if you're trying to lose weight and you're 300 pounds and someone else next to you is 300 pounds and they want to do the slow route, which is the healthier route, right? Run, you have less likelihood for that damage to your body to come in and then you get fat again. But what a lot of people thought they should have done was, instead of raising slowly like this, they actually raise quickly to then cause a recession. That way the pain is a shorter amount of time. And that's overall kind of how I've thought about it lately. That's just one of the points there. It's a very important point because they have such a small, if you want that soft landing, they have such a small lane to land that plane that it's very, very difficult. And that's why he seems nervous. That's why he's like, we don't want to cut too fast. That's why he's saying those types of things. But with a cut, usually you do get a surge. So if we do get that first cut come in, quarter one or something like that, you do have those scenarios where we actually rise with that cutting of rates, and then something in the system causes us to go into recession. Let's look at another note. Let's see. So we kind of covered this one, but it just relates to everything. And then, okay, how price reacts on Fed Day. Let's just pull up like a 15-minute. Price on Fed Day a lot of the time reacts to this the release, right? The release of the statement, the release of the interest rate decision, and we really react to how he talks. And what does he do? He just repeats what was said in the decision. So if you do see that bullishness most likely will continue until we start getting asked questions. That's overall what we were paying attention to. So a lot of the time on these Fed days, you can see an up move for a couple days even after, and then that is pulled away. And that's where the pricing in of what was expected comes into play. So that's overall. I've watched a lot of Fed days now. And a lot of the time we do head in one direction for either the day of and we top out, or we even head in that direction for a couple days and then we top out. So there is a good likelihood coming up into the monthly, coming up into the daily, being above the weekly, that we might be topping out this week. And we're going to talk about that mainly over the weekend on that Saturday video. Inflation, how sticky is it? We kind of went over that. It's sticky but unless you have recession. So recession is what causes the demand to actually come down. So it's funny that he said demand didn't necessarily cause like the inflation problem, because demand is exactly what is causing the problem. And the fact that you're seeing GDP growth, a good follow-up to the GDP growth is how many defaults are we seeing on credit cards? Are credit cards more maxed out? And the answer to those questions are yes, we are seeing defaults increase. We are seeing credit cards get more maxed out. We're seeing people open multiple credit cards. So this could just be overall more feeding into a bubble that could be at the end of it consisting of major credit card debt. See if we have any other ones. Rate hikes, are they really on the table? Well, the short answer to that is probably not. They're probably not. I think they're keeping the rate hikes on the table idea in case inflation comes back. And that's just kind of to save there. I don't think we're going to see another rate hike. I think they're going to think they did a good job and we're either going to go into recession or we're going to see inflation come back pretty heavily. Please, share your thoughts with me, because I mean, I'm just kind of spitballing here, but for the most part, that's how this plays out. It's either they cut too fast and we see that inflation come back, or they cut because, we're going to go into recession and they need to start to cut those rates in order for the economy to be able to grow in the future. So let's look if we have any other ones. Okay, why are people not purchasing right now? I thought this was very funny that he said they have no place to put their new stuff. Okay, do you really think people are going to stop purchasing stuff when people have become so accustomed to purchasing stuff on Amazon and putting it in their closet? Come on, this is a silly statement to me. The reason that people might not be buying as much stuff is because they have no money to buy anything anymore. They have no more room on their credit card. We're seeing credit card default go up. So that's a big point that I think he just kind of blew off, because if he actually answered it, it would have been very negative. And you can just see right after he talks, it's negative enough. We're seeing it start to come back down. Look for that to land back into the 68% zone by Friday underneath this purple line here. Even if all bears short exit still, it won't fall as Fed rate hike has stopped and Powell says to reduce rate hikes. Yes, but that was already priced in. So people already bought into that expectation, and that's why we could see some kind of pullback. And that's why I keep saying pullback. A lot of, I put crash on stuff because I think it could be a little dramatic because we've really headed upward. But I don't necessarily see this being the ultimate crash. I see this being a pullback in order to get more people in, and then we're going to see that extension with the rate cuts that you're talking about. But as of right now, we do have options expiration on Friday. So this market could want to go up. There's a ton of, we talked about it in the video last night, ton of puts in the system, right? I think there's the SPY for Friday's expiration has a 2.4 put call ratio. So, I mean, maybe this is as far as the market makers expected the month to go. So maybe now they actually do start to sell those positions of calls and actually do go towards the put side. But as of right now, you do have a 2.4 put call ratio. So if you're a contrarian, you'd say, hey, the market could even squeeze a little bit higher just to kind of screw over as many people as possible. He's not, and by the way, that's not the best way to put it. He's not reducing rate hikes. He's not hiking. There's a big difference in the reduction of a rate hike and not raising. That is very, very different. Because if you're reducing a rate hike, that could mean he's going from 0.5 to 0.25. But if he's not raising at all, that means 0. It means 0 and the projection of going minus on those basis points next year. A little bit of a difference there, but I think we know what you meant. So after this, let's go look at Tesla real quick because that had a big reaction. Now, we do give you those expected moves on my Patreon for these individual stocks. I can tell you that Tesla's was right down in this area. So we came down to pretty much that expected move for Tesla, and then we're seeing that start to bounce up. Now we'll have to see, is that able to go further into positive territory? We're going to see some kind of squeeze as some of these stocks have been going down while the Qs and SPY go up, or is it going to roll over and continue the negativity, continue by taking out this little low right here? Something I'm paying attention to, I noticed AMD went negative, Microsoft negative, Apple's up 1%. And then maybe we should pull up a daily here and just look at these yields, because you can see they're really coming off. But this means that more was most likely priced in than this move, honestly. So now we're saying even more rate cuts are coming than we did before we started the talk. And overall, we're testing the 200. We could see this start to spike. My actual target line of 4.062% actually did get tagged, so that's good. Dollar creeping down. So if this does keep coming down, you do have a little bit of a channel here. You could have some kind of reaction, maybe get some kind of divergence before we see some kind of pullback. And that's what I was saying. Either we're going to, melt up with this news, or we're going to pull back extensively with this news. And where this is sitting right now, it really looks like we're going to pull back. So let's look at NVIDIA. You can see NVIDIA, this is what's happening. This is what we talked about. Look for that to fade. If we start to look like we're going to cross, look for it to fade. And as of right now, we're fading. Okay, we're fading. So just keep that in mind. Now, throughout tomorrow and next week, this could cross and we could see that extension. But for now, you're seeing that Fed press conference just caused NVIDIA to slightly pull back at the end here. So we have to pay attention to it because NVIDIA is the thing that really kind of led us in this overall downturn. But you notice the difference between NVIDIA and the Qs right now. Qs way up here, NVIDIA is way down here. Anybody have any other thoughts? Maybe a point that I might have missed while he was talking? He really seemed, and tell me if you think this, he seemed nervous. Like he seemed flustered at times. And it's very important to pay attention to how they're actually how he is saying things, right? Because we talked about that one time. He was trying to be very hawkish, but that's how it came off. It came off as he's trying to be hawkish, which to me meant, hey, he seems pretty dovish. And we talked about that. But let me know if you guys saw anything else. But right now, what I'm noticing is we're pulling back from exactly where we pretty much should. This zone in here is what we talked about. I believe in last night's video, how we could come all the way to that monthly expected move and see us drop down from there, because that's all that is priced in for the month of December, which tells us that, hey, I know this is a 15-minute, but if we want to go touch the bottom side, we still have a little bit of time. We could go do that. 370, 349, we could do that by the end of the month. So if you need those monthly expected moves, just click on my last video and pause it when I'm looking at the Qs, and you'll be able to see those. I give it for the SPY and the Qs, and then we give it on the Patreon for the individual stocks we cover: Apple, Amazon, Tesla, NVIDIA. And I'm thinking about adding